Welcome, everybody. It's Joe Fahmy. It is Friday, November 28th, a little after 1:30 p.m. Eastern. Good morning, afternoon, evening, wherever you are in the world. Hope everybody here in the U.S. had a wonderful Thanksgiving holiday. I appreciate everybody being here. I just want to go over the structure of this webinar. I'm going to go through some slides talking about some of the fundamental characteristics of stocks, technicals, and open it up to questions after that. Show you how to build the stock screen as well. And so again, I appreciate everybody being here. I always say this in my webinars. I'm very grateful for everybody for taking the time, especially on a holiday weekend, to be hanging out with me. A sign of successful people, or one of the characteristics of successful people, is their desire to improve themselves. And by being here, you're obviously looking to learn and looking to improve. So I respect that tremendously. I don't take that lightly, even though it is a free webinar, but I want to give it my all as far as answering your questions and hopefully dropping some knowledge and inspiring you with some knowledge. Really quick, it's just a disclaimer here at the bottom of the page. This is solely for informational and educational purposes. Does not constitute an offer to sell or a solicitation of an offer to buy security. So everything is basically presented. Any of the stocks presented is not a buy recommendation, and this material does not take into account your specific investment objectives. So please consult your financial advisor. Bottom line, I always say every disclaimer should say just don't be an idiot, but that's why I'm not a lawyer and I don't write disclaimers. So anyways, it's all presented for informational and educational purposes. So as I said, just a quick introduction for people who don't know me. My name is Joe Fahmy. I manage money with a firm called Zor Capital. I also run an educational product at my website, joefahmy.com. I've been doing this close to 28 years, 27, 28 years. I'm 108 years old for anyone who is curious. I've been doing this for a long time. And I just enjoy the markets. I enjoy combining fundamentals, technicals, figuring out market direction, interpreting what the market, the institutions are doing. The real sort of thrill of all this is trying to find growth stocks and stocks that can maybe, change your month, change your year, maybe even help overall with your overall process of trading, wealth building, and so forth. So that's basically what I've been doing. And in my educational product, I go over 4 signs of a healthy market. I'm going to present one of those to you. 18 fundamental characteristics of the biggest winning stocks throughout history. I'm going to present a few of those as well to you, and some of the common technical patterns. And then we'll open it up. I'll show you how to build the stock screen and Q&A. And yes, that photo of me, that headshot's from about 30 years ago, so I get it. Anyways, let's start off with this. And if you have any questions, by the way, about anything I'm saying, please ask it through the Q&A instead of the chat feature. It's easier for me to follow on Zoom. And also, I have no problem if you have questions about what I'm talking about at the current time. If you have any questions about any specific stock or market related or ETF or anything like that, if you don't mind, save that towards the end, because it'll be easier to answer all of those at the end. But if I'm talking about, for example, a sign of a healthy market, and you have a question, please fire away through the Q&A, and I'm happy to answer it. I don't want it just to be me lecturing. I want it to be somewhat interactive with some questions. So there's 4 signs of a healthy market that I've determined, or that I like to look at. But I'm going to share one very, very simple one, because when you attend a lecture, a seminar, any sort of talk, they say if you get one thing out of it, it's worth it. And I hope you get more than one thing, but if you just remember one thing out of this, is a very, very simple process of the 50-day moving average. You can use the NASDAQ, you can use the S&P 500. Some people say, why do you choose one over the other? It doesn't really matter. For the most part, they correlate. It's very rare you'll see the NASDAQ do this and the S&P do that. Once in a while, one might outperform the other. But I like the NASDAQ because it's over 3,000 stocks. It's a larger sample size. Number 2 is it's also more of the growth area of stocks. Yes, the S&P is more equal weighted, but either one, whatever works for you. and just plot the 50-day moving average, a simple moving average. And the whole concept here is if we're above it, for the most part, the market's healthy. If we're below it, for the most part, get defensive and maybe protect capital a little bit more. And as I say in the slide here, it's not an exact science, but this is just a general green light, red light to be in or out of the market for people who like to actively manage their portfolios when we're above it or below it. Because a common question is you want to get to the point where you can answer this on your own, so you don't have to ask somebody, what do you think of the markets, or what do you think here, and all this stuff. Just plot a 50-day moving average. If we're above it, for the most part, the market's healthy. Again, green light. The institutions are supporting the markets and so forth. If we're below it, like we were in the bear market of 2020 during COVID, or 2022 when the Fed was raising rates, or recently when the market was correcting during the tariff scare in February, March. If we're below it, it could be a simple way to just protect capital and get more defensive. And if we're above it, I don't argue with the market. I try to stick with what, with the trend. The reason the 50-day is important is because that's an area of institutional support when you study charts. If we're above it, or when we come down to that level, if the institutions are supporting it around that level, they're the ones that control the markets. They're the big pension funds, hedge funds, mutual funds that trade hundreds of thousands, if not millions of shares. So I want to follow what they're doing. If they're supporting it around the 50-day and the markets overall, and you can use this with individual stocks. If somebody says to me, hey, Joe, what do you think of this stock? I'll look at anything. I don't mind. But if it's decisively below the 50-day, below the 200-day, I'm probably not interested. Unless you're a value player, then that's a different story. But for my style, I like to use the 50-day. So again, just to simplify for anyone who hopped on late, and I appreciate there's a lot of people here, so I appreciate everybody for being here. For people who hopped on late, if we're above it, for the most part, the market's healthy. If we're below it, protect capital, maybe reduce position size, or get a little bit defensive. And again, that's for people who like to actively manage their portfolio. So what I like to do with my educational product is, in a sort of a linear process, start off with, is the market healthy or not? Do the institutions have our back? And because 4 out of 5 stocks will move with the general direction of the market. So you kind of need to have a bigger picture view of understanding where we are in the markets. You can sit there and argue with it. You can say, well, I'm bullish here and the market's going straight down, or vice versa. I just think you need to be on the right side of the market. And that's what I try to do with my educational product, is keep members on the right side. Now, check. Right now, we're above the 50-day, to use present day example. The market's healthy. We're above the 50-day. So now, if it's healthy and the institutions are supporting the markets, let's move on to step 2. Again, this is for people who like to trade individual stocks. Wouldn't it be nice if you chose stocks that go up? Wouldn't that be nice? That maybe appreciate in price? I mean, I know it's boom. It's a novel concept. Aren't you glad you came to this inspiring webinar? I mean, I would like to buy stocks that go up. I don't want to sit in dead money. I don't want to buy stocks going straight down. I want to buy stocks that, for the most part, are going up. And if the market's healthy and you're growing your earnings and sales, for the most part, a company will appreciate. If you own a small business and you increase your earnings and sales, doesn't the value of your company go up? I know. It's amazing how that works, right? So what William O'Neill did, founder of Investors Business Daily, is he did studies on the characteristics of the biggest winning stocks before they became big winners. Before is underlined, it's in bold, and it's in capital letters to really stress. They studied, what did McDonald's look like before it became a big winner? What did Home Depot and Walmart in the mid to late 80s, what did they look like? What did Microsoft and Cisco in the 90s? What did Nvidia currently? All of these studies going back over the last 100 years or so, what did the big winners, the big stocks that went up 300, 400, 1,000% over time, what did they look like beforehand? And there's 18 characteristics. We'll share with you some of the main ones. Is basically growing their earnings and sales. And it's not just growing them, it's growing them quarter over quarter at least 30% or greater. So one of them is growing your earnings. And what you want to do is compare, for example, the fourth quarter of this year when the earnings come out in January. You want to compare the fourth quarter of this year to the fourth quarter of last year. So you're comparing apples to apples. Like in retail, it would make sense to compare the fourth quarter, the holiday shopping season, to the holiday shopping season of last year. So you want to, it's year over year growth quarter. You're looking at this quarter versus the last quarter. Same thing with number two, increases in sales. If you're growing your sales as well. 80% of the big winners came from consumer retail. Retail's restaurants, retail is clothing and apparel and so forth, consumer related. Computer related is sort of wide range with software, could be semiconductors, computer related. Drug and medical, don't underestimate drug discoveries over time. Financial, and then leisure and entertainment. Sometimes it's something like Lululemon years ago was a big winner when there was a yoga boom. If you look at Brunswick, there was a big pool and bowling boom in the 60s. That stock went up 1,200%. So throughout history, it could even be a fad or some sort of a new leisure trend that is going on, whether it's bowling, yoga, or whatever else there is. And then technicals is very important, where 99% were above their 200-day. And going back to the 50-day, 96% were above their 50-day. And again, this is before they went on their big moves. So that's why it's really important to say, okay, what did they look like beforehand? And then try to find stocks in the current market that match that similar pattern. So hopefully so far so good. People are awake. I know you might be in food coma from leftovers or turkey or whatever it is, but hopefully you're paying attention. If you're not, wake up. Anyways, so step number one, what I like to do, not only for my own, for the educational members and managing money, just for my own thought process is, are we on the right side of the market? Are things healthy? Check. Now that they're healthy, let's try to find some good stocks that are going to go up. I like to buy stocks that go up. I mean, they don't all go up. You have to have a loss cutting, a money management or a loss cutting discipline and risk management and all that. But my point is, let's at least give us a shot with some stocks that could possibly go up. Now, step number three is, okay, now you've narrowed it down. This is where entry point is very important. Some people are just hardcore fundamentals and never look at charts. I always say, who cares? Do what works for you. I'm not imposing my ideas. I'm not imposing my beliefs. I'm just trying to help. My point is, the market is not easy. It's designed to be difficult. So why not use everything in your power to give yourself an edge? Everything in your power to help yourself out, to stack the deck in your favor. So some people are hardcore fundamentals and they don't look at technicals at all. Some people only look at technicals and they don't look at the fundamentals. I'm saying, why not look at both? Try to combine them both to help your overall chances of doing well in the market. Moving averages, exponential or simple? Great question. I'll get into that when I show you the charts, but for the most part, they're simple 50-day, simple 200-day. They're going to roughly be the same. It's a common question I get, and it's a great question. It's just not that far off. For the 21-day, which I'll get into in the charts, I do use the exponential, and I'll explain that in a minute, but great question. For the most part, 50-day moving average, it's simple. 200 is simple. So we're trying to keep things simple. So now, market's healthy, let's say, and you found some great stocks. Entry point is very important. It's nice. Let's say if you buy a stock at $50, I'm trying to be patient, but within a few days or a few weeks, if it's at 52, 53, 55, it starts to move in your direction. What does that help? It makes you feel good. It's not about feeling good. It gives you a little bit of confidence so you're not stressed. Nothing worse when you buy a stock at 50 and now it's at 42 and it's at 35 and you're getting buried. It'd be nice if you buy it properly. So these are some of the common technical patterns. The most two common are cup with handle and double bottom. And a lot of people ask me, what does a cup with handle look like? And it's actually a funny question, but it's not, because years ago, I remember I was at a seminar or something. I literally raised my hand. I'm like, what is a cup with handle? Like, what does it look like? It's literally the trace of, think of it as holding a coffee or a tea mug or something, or a cup with a handle. And I know it's a funny name, but these patterns tend to repeat themselves. So these are some of the characteristics where usually have a prior uptrend, and then during a market correction is when bases are formed. So you have a prior uptrend, that's point A, and then you have a base that's being formed. B is the cup, and C is where the start of the handle is. Now what happens is everyone who bought at point A, they tend to sell at point C. You ever do this where you buy a stock and you're buried and you say that prayer, please let me get back to even and I'll get out of it? Yeah, we've never been there, right? Hashtag sarcasm. My point is that's what creates the handle is people, in this example, this is a weekly chart of Microsoft from the 90s, but the patterns all repeat themselves. So who cares what, if you use something from 1914 or you use something from the current market. It works on daily charts, works on weekly charts. People who, the stock goes from 40 to about 75 and they chased it. Now it comes back around to 75. This is the people who chased it and want to get back out at even. They start to sell. Then you wait for the sellers to dry up. You wait for the volume to dry up. And around that time, as it emerges out of a base, is where you can get a strong entry point. And I always say, no matter what your time frame is, short, medium, or longer term, get strong entry points. They can really help build your confidence. That's one of the phrases I use with my educational members. The goal of the product is to produce calm and confident traders. You want to trade from a position of strength, a position of confidence. You don't want to be hyper. You don't want to be chain smoking cigarettes, looking at every 1 minute chart, shooting a heroin needle in your arm because you're freaking out. You need to relax, be a little bit patient, get strong entry points. It really helps not only relax you, but helps you with your confidence as well. So I'm going to get into how to build a screen off of these concepts and take questions, of course. But for people who don't know, I have an educational product at joefahmy.com. What I do is I go over all of these concepts. It's like 4 or 5 hours stored on there with seminar videos from start to finish, figuring out if the market's healthy, deep into the fundamentals, deep into the technicals, entry points, market tops, psychology, all sorts of stuff there. So that's in the seminar that is there. And then I do a weekend video every Saturday and a midweek update every Wednesday, kind of to take the concepts of that are taught in the seminar and do our best to apply it to the current market. Plenty of stock ideas and so forth. And then regular webinars where I go through screens similar to the ones I'm doing now, and I take questions from members. So for people who are interested, there's a promo code, take 100 off. It's sort of a Black Friday special, I guess, because some people emailed me and asked if I was running one. So why not? Ask and you shall receive. But anyways, the promo code is for $100 off a quarterly subscription. And then also, it's mentioned here in the first slide. Sorry, let me go back. Also, my web team will add an additional month for you. So you'll get a month free. So it's normally a quarter, 3 months. So it'll take you till the end of March, March 31st of 2026. So kind of like you're getting 4 months. So you get $100 off, and my web team, after you sign up, will give you the $100. Excuse me, we'll give you the additional month. One last thing, there's a million books written on the stock market. These are some of my favorite ones. How to Make Money in Stocks. I thought I had it nearby, but I don't. I usually have it nearby. Anyways, it's orange cover, William O'Neill, 4th edition. Go through the first 100 pages in that book. It's one of the greatest lessons in technical analysis, where they mark up a lot of the charts throughout history, buy points, faulty bases, strong bases, areas to sell, areas to stop yourself out. I think it's, for whatever the book costs, $12, $15. It's one of the greatest lessons in technical analysis. A lot of the Jesse Livermore books are great for psychology. The Mark Douglas books are great. Victor Sparandeo has awesome books on market timing. And again, someone might say, what about this book? What about that book? There's a lot of them. I'm just trying to show you, you're not going to read 40 books this weekend. Maybe you are, but I'm just trying to show you some of the ones that have helped me. How to Trade in Stocks, Jesse Livermore is great. How I Made $2 Million in the Stock Market, Nicholas Darvis is a great book. It's a great title. I've always joked that if you want to write a book on the stock market, title it How I Made $3 million in the stock market. Because if you're in the bookstore and you see them next to each other, How I Made 2 million or How I Made 3 million, I don't care how the person made 2 million. I want to know how they made 3 million. See, I'm always thinking, I'm here to help. It's kind of like Something About Mary with the 7-minute abs and the 8-minute abs. I don't have time to do 8-minute abs. I want to do 7-minute abs. It's a similar concept. I'm joking, seeing if people are paying attention. Battle for Investment Survival. When you asked William O'Neill, they asked him, what are some of his favorite books. He mentions that and reminisces of a stock operator. There's more than three, there's an old slide. There's more than three Market Wizards books, but these are books written by Jack Schwager, interviews with some of the top traders, with William O'Neill and Paul Tudor Jones, and the list is endless of so many great traders and money managers throughout history. And it's great to kind of pick their minds. I always say success leaves clues. So study successful people. If you're a fundamental value person, study Warren Buffett, Graham and Dodd. Fundamental, read some of Peter Lynch's books, which I don't have here, and they're great. If you're more technical, there's some great books that are listed here. So try to find a style that fits your personality. If you don't have a personality, go out and get one and come back. And try to find a style that fits your personality, and then find someone who is successful at that style, and then mimic it with. You don't have to do it exact. There's no right or wrong in the market. There's no real black or white. There's a lot of gray area with a lot of things in the markets. Just try to find someone who's been successful and mimic them with your own style, your own flavor. And then, of course, there's a lot of great books with mental toughness. Someone asked me one time, what's the greatest book on the stock market? I said, Think and Grow Rich, Napoleon Hill. And they're like, that's not about the stock market. I'm like, just read it. You'll understand. Because it's all about mental toughness. If you want to be successful at anything in life, you want to be consistently successful, you need that mental toughness. You want to be average, that's fine. You can be average. But I'm sure by being here, you want to have a little bit of an edge and be above average. And it involves a lot of mental toughness. That's why I preach a lot of that, to help build your confidence when you're approaching the market. So just a reminder, someone asked what the discount code is. It's take 100 off. Good through this weekend, and you get $100 off and an additional free month. So let me go over. This is live. Give me a second. Let me go over to. Let me share my screen with Market Surge. And there's still a lot of people hanging out here. So maybe you've fallen asleep. Maybe you're still engaged. I love it either way. I appreciate you being here. I'm going to show you from. Let me just grab some water really quick. I'm going to show you from the screen I just showed you on how to build a stock screen. There's a lot of different software products. This is Market Surge, used to be called Market Smith. I like it because it gives everything you need on one page. And I have a bunch of screens here. I have the stock screen 30 for 30. And when you open it up, it's very, very simple screen. I'm a big fan of being resourceful. I want to make this point because it's a common question I get before the question comes in. People think there's magic in the screens. The screens are not magical. They're very, very simple. The magic comes in putting in the work. It's kind of like someone can give you an exercise program. Someone can give you a diet program. They're pretty simple. Get off your ass, eat an apple, and go for a walk. It's not that complicated. The magic comes in from doing the work. Same thing with screens. They're very simple screens. People think it's like the Wizard of Oz, like what's behind the curtain, what's in your screens. It's not that complicated. It's actually very simple. The screening isn't the concept. It's putting in the work and screen time, and putting in the work and doing some research. For example, where does this 30 for 30 screen come from? It's everybody who's had 30 home runs and 30 stolen bases. I'm kidding. That's for the baseball fans out there. There's over 11,000 stocks in the Market Surge database. I start with a relative strength of 90 or above, greater than or equal to 90. And then stocks that have sales, 30% quarter over quarter, greater than or equal to 30. Stocks that have earnings, greater than or equal to 30. I just picked $20. You can pick 5, you can pick 80, doesn't matter. And then, stocks that trade over 200,000 shares a day, so they're somewhat liquid. Some people bump it up to 500,000. If you're managing money professionally, maybe you want something that's liquid. If you're trading some money on your own and you're okay, maybe the liquidity is not an issue. To get in and out of a few hundred shares is no problem. But by running this screen, it brings a database down from 11,000 to, in this case, sometimes there's 50, sometimes there's 100. In this case, 82 stocks. At least, what did I say earlier? You're giving yourself a shot. I'm not saying, again, the disclaimer from the beginning, I'm not saying, and I'll go through these stocks, that these are the stocks to buy and the only stocks in the market, but at least you're narrowing it down to give yourself a shot. William O'Neill used to say 90% of people fail because they buy nothing to write home about stocks. They buy garbage, stocks in downtrends, stocks that are slowing their growth. At least give yourself a shot with stronger stocks. And let me explain really quick where the screen comes from for people who hopped on late. Let's go back to this slide here, share, slide, and bingo. So where does the screen come from? Relative strength of 90 or above. See point number 4, the average relative strength of the biggest winners throughout history. Again, the keyword is before they made their big runs was 92. You can pick 85. I think O'Neill said he never bought something below 80. You could pick 95, 88. Who really cares? I just picked 90. There's no magic behind it. It's because the screen comes from the greatest winners throughout history. So I screen for stocks with greater than or equal to 90 relative strength. The relative strength is not RSI. It's a proprietary ranking in the Market Surge database. Year over year, quarterly earnings growth 30% or greater, and increases in sales 30% or greater. That's it. I just took studies from this, and you go back to Market Surge here. Bear with me. Let me share that. And you go back to this, and that's where the screen comes from. You take, I mean, it's kind of a simple concept. You take the biggest winners throughout history, what do they have in common, and try to plug them in to a screen. It gives you 82 stocks. Now, you get the update here. And then what I do is I go through these. If you have any questions, please fire them away because I'm hoping people are paying attention and following along. But what I do is I go through these screens. I look for, at least I know in the last quarter, it's at least 30%. Earnings is at the top, sales is at the bottom. It's at least 30% year over year growth. See, all of these, the screen does it for you. And then what I do is, this is where the time comes in, the work comes in, if you're passionate about it. I had one member tell me they're not passionate about it. That's why they pay me to do it. That's fine too. But I just encourage people to put in some work. What I try to do is look for bases. I look for themes. I'm paying attention to sectors that are strong. I'm just getting a feel for the overall market. I'm getting a feel for, what stocks may be basing out. Can you please explain this candle type? These are, I believe, just open, high, low, close. I think, or maybe they're just this candle. They're not candlesticks. They're just simple bar candles. I think I don't know if it's open, high, low, open is like this, and then they have the high, low, and then the close, something like that. This just might be the bar for the day and then where it closed. Sorry, I'm not drawing a straight line. But when I look at these, sometimes they're just showing the, so it's basically the high, low, and close bars. That's all it is. So hopefully that helps. And I'm just going through paying attention to sectors. I'm going through looking for bases, maybe looking for some consolidation, seeing if stocks are above the red line, the 50-day. Somebody says not using TradingView. No, I mean, it's a great product. I have not tried it, to be honest with you. I'm happy to check it out, but I know that's a great product as well. There's a lot. That's why I said this is something I've been using for a while. But again, I always say do what works for you. I know there's a lot of different great products out there. So it's just something I've been using for a while. So I go through here and I'm just looking for bases. I'm looking for themes. I'm looking for just to get a feel for the markets. I'm seeing if something, maybe broke out of a base and maybe it's too extended to enter for me. But again, this just comes from putting in some time, putting in some, some screen time to get a feel for, if I see something below its 50-day, I'm probably not interested. But I'm going through here and you've already seen in this screen so far, we've gone through 15 of the 82, and there's a lot of medical, biomedical, biotech, medical products. Already there's like 8 of the 15, more than half of them are in that sector. A light bulb goes off. Maybe that's a strong sector. Um, what else is there? Is there something more specific you try to aim for when looking for strategic entry? Yeah, exactly. I'm looking for either that type of cup with handle that I showed you in the technical pattern, that type of entry point, or if I missed a breakout, I'm looking for a pullback buy. And I get into a lot of this with my educational members. Maybe if I miss something, because you can't be in everything and you can't see everything, maybe look for a pullback buy if it's orderly to a moving average. Again, depending on your time frame. And that's a great question. It's kind of a loaded question because I could go on for hours on that one. Um, Somebody's saying greetings from Germany, Hamburg, and happy Thanksgiving belated. Thank you for that. Appreciate you being here. Um, let's see. How do you count bases, or do you let them from market surge? That's a great question. It's also the base count, you can get it from market surge. I also like to look at it as I look at it as if we came out of a bear market correction, it's pretty much a first stage base for me. But I do look at that. I count them myself, and sometimes I might use the pattern recognition and market surge to count bases. So I think over time, I rely less on the pattern recognition because I've seen enough things. But when you're new to this, definitely you can use the pattern recognition. Also, when something's really extended from an initial base, and it starts to get wide and loose movements, that's usually the sign of a later stage base as well. So somebody's saying yes, for sure it's nuanced. Yes, and I'm glad you understand that. Um, because there was the question on, is there something more specific you try to aim for entry point, support, resistance? It's an awesome question. I say this all the time. A lot of people, some members here, let's say, or some of the attendees might be on IBD Live, or attend things or in chat rooms where they ask questions. A lot of people think there's a right and wrong answer to a lot of these questions: position size, number of stocks owned, where to enter them, where to sell, where to stop yourself out. There is no right or wrong answer. It's not a cop out. The God's honest truth is it depends. You want to try to answer them with the high probabilities, but sometimes it depends. Like maybe breaking out of a base, you might want to take a 20% gain, let's say, because O'Neill says that when you break out of a cup with handle, stocks go up about 20% before they reach some sort of, on average, before they start to correct, build a new base, build a 3 weeks tight, or maybe come all the way back down and retest the breakout. So that's why he says maybe shoot for 20% with a stop of 7% if you're buying properly. That way you can be right on 1 out of 3 stocks and still make money. You pick 3 stocks, one goes up 20%, you stop yourself out 7 and 7 on the other 2. You're only right on 1 out of 3, but you still grind out a profit. That's a good guideline, but if something's coming out of a high tight flag that could really go up 100%, I might shoot for more than 20%. If we're in a choppy market, I might be happy with 10%. So I love that you are recognizing a lot of this is nuanced. There is no right or wrong answer. You can ask whatever questions you want, but I always say this: don't think me or anyone else has the right answer. It's just based on probabilities and statistics, but entry point is very nuanced. There's a lot of instincts, feel, and I know people don't really want to hear that, but it's not robotic. It's getting a feel for the market, if we're later stage in a run, if we're early in a power trend, if we just had a couple follow through days. For example, let me go back to the NASDAQ. Coming out of this tariff scare here, back in February, April, we identified on April 22nd and April 23rd 2 follow through days, and we had a Zweig breath thrust. We get back above the 21 day and we start a new power trend. I'm going to be much more aggressive here than I would be later in the trend, something like that. So hopefully that makes sense, because I hate the expression of timing the market, because someone says, okay, you're trying to get the highs and trying to get the lows. I don't care about any of that, nor do I claim that I'm trying to get the high. I'm not even looking to do that. The bulk of the money you're going to make is here. This is where from May till into August, September, as I'm sure you even into mid-October, I'm sure you saw it. There were plenty of stocks that not only went up 20%, that went up 100 to 400%. That's where you're going to make the bulk of your money. I'm not claiming to get in here or get out here. I'm just trying to trade the meat or the sweet spot of that power trend. Hopefully that makes sense. Somebody says I'm a newbie. Where do you think I should start? I think you should start drinking. It's a lot easier. No, I'm kidding. Get the O'Neill book. I think it's helpful. How to trade in stocks. Start small. Build your confidence. I always say you can't learn how to lift 25 pounds until you learn how to lift 5 pounds. Don't trade with fear and don't feel like it has to be all or nothing when you trade. I'm not a fan of paper trading because you don't get a feel for things until you put your actual hard-earned money into it. But there's nothing wrong with buying 10 shares. There's nothing wrong when you say, I want to try this out, and I normally buy 100 shares, but I'm a little bit nervous because I'm new, and I'm not making fun because I used to be there too. I'm just saying, instead of buying 100 shares, buy two or three, buy 10 shares. Try this out with the 5 pounds so you can learn how to lift 25 pounds. Start with 10 shares so you can be more comfortable trading 25, 50, and 100 shares. I'm not talking down anyone. I'm not being insulting. I'm just saying, when you're new, read some books, learn fundamentals, learn. I like the O'Neill stuff. I'm not like, paid to promote this stuff or anything. I just like the concepts that are taught because they make common sense to me. Some people are more value and they don't like trading growth stocks. So do what works for you, but find a style that works for your personality and start small and work on building that confidence. And it takes time, but you got to put in the work. You got to put in the work. You can't do 10 sit-ups and say, why don't I have washboard abs? It takes time and effort and consistency, and that's what I encourage you to do. Let me go through the rest of the screen here because somebody said, okay, shut up and go through the rest of the screens. They didn't say that. They just wanted me to continue with the screening. So I'm basically going through, and as I said, the screen already filters out 30% earnings and sales growth, but I got to combine it with a proper time to buy, back here after the follow through day and here off of a cup with handle rather than when it's in a downtrend and correcting, or maybe off of a second stage base there where you had an entry point there. That's what I'm looking to combine. So the screen already filters it out, but now I'm trying to combine technicals, by looking for bases, by looking for some sort of tight price action, by looking for, something like this. And again, it's not a buy recommendation. I don't own this one, but, maybe looking for some sort of a handle to buy off of where the volume and the sellers might be drying out. That's what I'm trying to find. If something is building a base, I might want to wait and see it to complete its base. And again, this is just, I'm trying to avoid stuff in downtrends below the 50-day. This is just screen time. For example, this is a real-time example. No bullshit, because I could even post a video for my members. Eli Lilly was building this big base. There was some unusual options activity, which I look at, and it was starting to consolidate in that 800 range on some low volume. I mentioned it. I bought a little bit for my clients as well. Mentioned it there as far as an entry point. And I mean, it's nicer to get it around this 850 range than to chase it after it's already run 300 points. That's an example of, in real time, where I take the concepts and apply it for the educational members for entry points rather than chasing extended names. So that's an example of how I try to apply this when I'm going through screens. What else do we have here? What's your view on volume? Is it still useful to keep an eye on, or is it corrupted by algo's dirty volume? Yeah. So Mike Webster's a good friend of mine, and I know that's a Mike Webster expression. It's dirty volume. I use it. He doesn't. I don't care. Do what works for you. I find it helpful because even if there is dirty volume from the algos, it's consistently dirty, if that makes sense. So I still use it. I find it to be very, very helpful. This is what I mean by everyone has different styles. Do what works for you. I respect Mike. He doesn't want to use it. That's fine. I have a really good friend who's a value person who buys stuff below the 200 day. That's fine too. I don't care what other people are doing. I just want to do what works for me. And I find volume to be very, very helpful. So I just, that's it. I don't know how else to say it. Um, let's see what else here. Like for example, especially in, when I look at the Nasdaq, I'm looking at the average volume here. That's why there's a red line of the 50-day moving average. I'm paying attention to any sort of distribution days, or when I talked about those follow through days back here on April 22nd, and sorry, it was back here on some of the volume, and then we started to see more volume come in. That's what gave me the confidence to stay fully invested during this time, because the volume was coming in. Whether it's dirty or not, I don't care. It's consistent and it shows up on the tape, and I find it to be incredibly helpful. So again, just my 2 cents, not arguing with anyone, just telling you what works for me. So again, going through the screens, there's some aerospace and defense, there's some medical products. Someone asked me if I look at weekly charts. I even posted this one. It's a new IPO. I don't know much about it. I can dig into it, but I go to a weekly chart. The week of the IPO, obviously there's going to be a lot of volume, but I pay attention to the volume there. The red line is the 10-week moving average of volume, and there's a lot of accumulation in this one. I look at the bars that are sticking out, whether it's buys or sells, as it's building its IPO base here. There's a lot of accumulation in the base. Now it's working on a handle, and that's something I would look at. So I also look at the weekly charts uh, as well there. Um, Somebody says, great job on finding Rocket Lab. It was helpful to know that you were bullish on it. Yeah, I did put that on my blog at like $10 off of that high tide flag, and it went to 70 something, 73. So I know some people did well on it, and I'm very grateful that you did. Do you have any similar high conviction ideas that you like to share, or reiterate a public idea you're super bullish on? Join my educational product then. I mean, I do like some medical products. I've been talking about XBI for a while. I'll just give you sort of an ETF, because when I screen, I talk about real time when I screen a lot of medical products, biotech and biomedical. So a lot of people don't want to deal with specific stock risk on, for obvious reasons, on biotechs. Now, XBI is more, excuse me, equal weighted. So the small and mid cap biotechs will get more of a movement on this. IBB is more market cap weighted with the big pharma, as Lilly and Merck and some of these Glaxo are starting to wake up. But I'll just give you an ETF. I've been talking about this one as it's been screening here. I've been talking about this one for about 2 or 3 months. And then I do like some individual names in this area as well, which I save for out of respect, please understand, I got to save it for my educational members. But this is one that has been screening and doing well. I wouldn't chase it here, but I have a little bit more higher conviction because, again, going back to these screens, the majority of stocks I'm finding are coming from this sector. So, and I'm glad you did well on Rocket Lab. So that's awesome. Is it a 10 MA on the volume? Yeah. So this is, let's just pull up Apple, for example. Apple is the red line is a 50-day moving average of volume. Just like there's a red line is a 50-day moving average. This is the average volume. So you can see the days that are sticking out, whether it's usually red or green, but it's blue or red here, whether it's buys or sells. When you go to the weekly chart, it is the 10-week moving average of volume. So it is overall on the weekly volume on the weekly chart there. So that's, someone asked me about that. Do you find sometimes there's lots of ideas and sometimes there's not much to do? Awesome question. Yeah, that's exactly right. Sometimes there's a lot of setups, sometimes there's not much to do. That's exactly right. And that's where I love the audience member who talked about it being nuanced. That's another factor when I'm screening. If I'm screening, I'm like, oh my God, there's so many bases here. We just had follow through days. This looks good. I'm stepping on the gas. You could even, use margin if you want. I mean, I'm not encouraging that. I'm just saying if you're experienced, it's like a stunt man. Don't try this at home. I'm not encouraging that. My point is I'll get aggressive if I'm finding a combination of what I talked about. Market's healthy, strong fundamentals, tons of bases setting up, then I'll get more aggressive. If I'm finding it's more wider and looser and we have distribution days and it's a little bit long in the tooth, so to speak, and it's been a great run, then I might be, and there's not many setups, then I might be a little bit more defensive or look to take profits. So, yes, that is a great question when I'm screening. But this is how I will say this is how I get a true feel for the markets because I don't mean this in a disrespectful way. I don't care about anyone else's opinion. I just care what the market's telling me. Do I respect Stanley Druckenmiller and David Tepper and Paul Tudor Jones and some of these amazing billionaire hedge fund managers? And it's not because they're billionaires I respect them. It's because they're consistently profitable over 20, 30-year careers or longer. That's why I respect them, because consistency is what makes someone excellent. Michael Jordan's not considered one of the best players in the history of basketball because he scored 30 points once. It's because he consistently averaged 30 points per game over a 15, 20-year career. So those are the people I respect. Do I respect them? Yes, but I'm not going to follow anyone blindly. At the end of the day, you got to understand, like someone like Stanley Druckenmiller, or when Carl Icahn talked about danger ahead, he said that at a time, these guys are managing global macro funds where they're not trading just equities. They're managing commodities and currencies, and the fixed income market, with bonds, is like a million times bigger than the stock market. So they have offices in Hong Kong and London and Dubai and San Fran and New York. They have teams and teams of people. When you're managing billions of dollars, you're not like, oh, let me just buy 100 shares of Microsoft here. These people are managing on a different global macro scale with many different asset classes. So I respect what they say, but at the end of the day, all I care about is what the market's telling me. I'm pointing at my screens that I'm looking at here. I'll show you an example when I'm done with this from COVID. And these are the types of names where I mentioned Micron, LIT, for example, as the data centers are moving from, the bells and whistles going into data centers, from moving away from copper to more fiber optic stuff. We mentioned LIT breaking out from there. And then if you missed it, you had another opportunity there where I mentioned it for my members. It's extended now to buy, but these are the type of ideas that I pass along. When Micron was between 125 and 85 for the longest time and started to emerge out of that range as memory prices are going up. These are the types of things that I pass along and try to identify for my members. So that's what I'm trying to do, as I said, is take the blueprint of the stuff from the slides I showed you and apply it to the current markets. I'm just going through a few of these quickly because I see some more questions coming in, and I want to show you an example from during COVID. So there's a few more here, and these are great questions, by the way, so please keep them coming. Yeah, some stocks might be, again, when you say there's not much to do, some might be setting up, some might need time to base. The more you look at charts, you'll just put in some screen time, you'll understand what normal is and what normal price action and what isn't. And let me see here. Taiwan Semi, that's one that's been on our focus list for a while. It's been, again, breaking out of a base there. Normal visit to the 50-day, ran up again. Normal visit to the 50-day, strong earnings and sales. I'm not saying to buy it here. It's been on, I have a focus list for members. It's been one that been slow and steady earnings, not just slow and steady, but it's been a decent winner because it fits the blueprint of big winners throughout history. So, let's see what else we have here. Pretty much done with this. So let me show you an example from COVID, what I looked at in the markets, exactly what I'm looking at for screening. Somebody asked me about the discount code, so let me just pull that up really quickly. If you are interested in the educational product, I'm confident you're going to learn a lot. I'm very grateful. I've been doing this almost 6 years. Knock on wood, I haven't missed a video. I try to be consistent, talk about that word consistent with my members, putting out videos every Wednesday, every Saturday, doing regular webinars like this. It's $100 off the Good Friday special through this weekend. The discount code somebody just asked me is take 100 off. In addition, you're going to get a free month. So you sign up now. You normally get December, January, February, if I can remember the calendar. You're also going to get March. So you're going to get access. My web team will give you access till the end of March. I'm confident you're going to learn a great deal from the product. I try to just basically speed up the process for people to try to help people speed up the process of the learning curve and so forth. Here, let me give you an example because I said I was going to talk about something from COVID 2020. This is when COVID happened, late February, March. And I remember because I also contribute to Yahoo Finance. Give me a second. Let me grab some more water. And some more questions are coming in. I'll get to them in a second. So, COVID, straight downtrend. We dropped 27 to 35%, depending on the index you look at, in a very short period of time, or 3 or 4 weeks. It's the end of the world. We're all locked up in our homes, and the news is miserable. I'm not taking it lightly. I know a lot of people were affected by it, but from a market perspective, we had a follow-through day on April 2nd on the S&P 500 and a follow-through day here on April 6th, I believe. Let me pull out the crosshairs. April 6th, if I can hold that steady there. Yep, April 6th there. And then April 2nd was there, 4/2 of 2020. I don't remember what I had for dinner last night, but actually I do remember what I had for dinner last night because it was Thanksgiving. I say that as a joke. I normally don't remember what I did the night before, but I remember random specific dates in the markets. My point is, I contribute for Yahoo Finance, and I wrote 2 articles saying the coronavirus, COVID numbers are going to get worse. It doesn't mean the stock market has to get worse. And people screamed at me like, are you nuts? This is the end of the world. We're going to zero. I made that call, and I wrote about it twice at the end of March and middle of April after I saw a whole bunch of setups and we started to see all of the confirmation come in. I made that call from one thing and one thing only: screening for stocks. That's what I mean when I said earlier, I respect other people's opinions, but I don't worship anybody, because if the market is telling me something different, when I use that example of Carl Icahn, who's one of the best and has one of the best track records throughout history, when he said danger ahead, whenever that was several years ago, there were so many setups where I was just saying, look, I respect the guy, but I'm not going to go sell everything and go short just because of one person's opinion. Even some of the best in the business can get it wrong, or they have different time frames and different objectives. That's why for my time frame, I screen, and that's everything I need to know. So I'm going through my screens and I see something like, DocuSign back here, building a cup with handle. And that's why I was like, all right, the market's horrible, but there's some setups here. I see something like Zoom, and I say this is coming out of a big IPO base in March of 2020. It's coming out of a big IPO base, and the stock went up, whatever, 500-600%. Now you might say, okay, DocuSign, Zoom, those are stay at home. And yes, there were a lot of cloud computing, Coupa software, which got bought out or went private. There were a lot of cloud related and all that. So that's fair. But where did the growth come from? From work from home spiked the growth, obviously, in Zoom and DocuSign and stuff like that. However, wait, there's more. If you hold on, I'm going to throw in some steak knives here. All right, so check this out. Netflix on a weekly chart. This is breaking out in April of 2020. This is breaking out of a 1.5, 2 year base there. You have something like Amazon. When I was screening, it ran up and it's breaking out of a big base right around the same time. Nvidia, you might have heard of this, came out a month later. Huge run up, consolidated, and about May of 2020 started to break out of the base. So there were also medical products. There was also, where was it here? DXCM, diabetes glucose monitoring, right around the follow-through day, was making new highs. So Seattle Genetics, which got bought out by Pfizer, but it's not on the database here. But my point is, I remember screening, and it was stock after stock after stock, not just COVID work from home related, but medical products, biotech, some of the, some retail, there were stocks starting to emerge, semiconductors. And I said, okay, just because the virus is going to get worse, it doesn't mean the stock market is going to get worse. And people are like, you're crazy, you're crazy. Then we run up and everyone's like, okay, we need to retest. And I'm like, we're still finding setups. And we kept going and kept going for the most part. My point is, screw what everyone else says. You don't want to, you can respect what people say and listen, that's fine, but don't be easily influenced by that. I don't care what anyone's saying. I care what the market is telling me, because that's the famous line that I've heard and I paraphrase it all the time. Don't focus on what you think the market should be doing, focus on what it's actually doing. And by screening, that really gives me a true feel for what the market's actually doing. So hopefully that helps. And that's why I screen, because it's the market telling me what's actually going on. Somebody's saying, for example, GROY. Let's take a look at that one. That fits your criteria. I don't know this one. Gold Royalty. It's a small cap name. I mean, yeah, there's been a lot of metal mining ore. This is definitely because it's number seven of the 197 industry. I don't know this one. It's a small cap name. I don't follow too many of the miners, but this is one, I mean, at least, again, it's not something I would probably trade personally, but looks good. Looks good. I mean, it's obviously it was up nicely today on a holiday shortened day, but I always say some people like, one, I can't follow all 11,000 stocks, and two, sometimes I don't trade certain sectors. It's fine, do what works for you, but at least what I like here is it's a stock with good revenue growth. Maybe the earnings come back later, but at least you're buying off a technical base. So it didn't show on my screens of didn't show up on that screen because one, my criteria is usually about $20 or $40, and two, it didn't have the earnings growth, but at least you had strong technicals. Trade whatever you want, just manage risk around that. Somebody's saying TradingView doesn't offer relative strength ratings, so don't bother trying it. I mean, look, I know some of my friends are running that product, or colleagues of mine. I don't know the product. I mean, I always say do what works for you. A friend of mine uses Finviz, Finviz. It's free to do their screening. You can do whatever you want. Who really cares? Do what works for you. I say that over and over because I used to think don't talk about religion and politics was the only thing, but you also don't want to talk about sports teams because people are psychotic about their sports team. You don't want to talk about burger joints because people are psychotic about that. If you like Five Guys and I want to go to In-N-Out, fine. Oh, Five Guys is better. Go to Five Guys. I'll go to In-N-Out. Do what works for you. Who really cares? It's the same thing with stock thing. People are like, use this software, read this book. You should do it this way. You should do it that way. You should, you should, what up. Like, my point is, like, I'm not here to argue with people. And thank you, by the way, for some of that feedback. I'm just trying to encourage people to do what works for them. I've studied some of the best. I've learned crumbs and bits and pieces, and I've kind of molded it into my own style with the blueprint. When you talk about CanSlim or Fidelity, Contra Fund or any growth fund, all it is a growth strategy. It's, people trying to find stocks that are growing and that are hopefully going to appreciate in price. So that concept will never change throughout history. The stocks will come and go. That concept will never change, but I'm just a big fan of doing what works for you. You don't want to use volume? Fine. You think unusual options activity is garbage? Fine. I don't care. That's the whole point. Life's too short. I'm not here to argue with people. That's my sort of 2-second rant. So speaking of unusual options activities, people ask me if I use the flow with my screening. After I screen, I do follow unusual options activity through 3 different sources to help give me a little bit added conviction in some of the names, whether there's put writing and I know there's going to be support, whether there's call buying that's consistent over time, that might give me added conviction to stay in a name. And that's a whole like 10-hour can of worms that I can get into, because talk about being nuanced. That's incredibly nuanced, but I try to explain some of that for my educational members. And thank you. These are great questions. Do you worry about secondary measures such as breadth, sentiment, or are you primarily taking direction from price action and any traction or lack thereof from the trades you're placed? Great question. the most important thing is direction of the market, earnings and sales growth, technicals, fundamentals. But yes, sentiment is a secondary measure. Seasonality is a secondary measure. You mentioned breadth. Yes, I do look at that as well. So yes, those are all added factors that are also, I love that word, nuanced. Um, those are also added factors as well. But I try to keep it simple, but I do pay attention to that. Platforms for options flow. Options Hawk is great. Wall Street Jesus is great. And I have some friends at Black Box. They also send me some, any good flows there. It's just great because the options market has just exploded and boomed to such a multi, hundreds of billions of traded whatever every month, and notional value and all that stuff. So it's good to have a lot of different eyes on them. But those are some of the ones that I use if you want to check them out. I'm not like endorsing anything. I'm just saying those are the ones I use. But I had a friend sign up for one of them, and he's like, "This is like a foreign language. I don't get it." It's like, sometimes it's like a social media, a Twitter feed of just data. I use it to complement the work I'm already doing, going back to what I said, putting in the work. I'll stick around for a little bit, and these have been great questions. So please, I appreciate you guys being here. And if you want to ask some more questions, I'm happy to do that. Again, in the educational product, just because someone did ask, um, I all of the stuff that I cover is pre-recorded in a seminar, about 4 or 5 hours, broken down into about 10 or 12 topics. That's there. You have the whole quarter to watch it. And then I try to take the concepts from that and apply it to the current market. So I do a weekend video. They're about a half hour long. I go through the markets, dissect the markets, maybe talk about some interesting things I'm seeing, and then go through a lot of stocks with setups, strong sectors. Because when I screen, I break it down into the sectors that look really good, maybe some trade ideas. If they're there, pass along some stocks as well. And then in the middle of the week, after a few trading days, I try to say, okay, what just happened so far this week? Any setups or anything to look forward to for the rest of the week. So I think the cadence of the schedule of it's pretty good as far as, it's not a day trading service. It's not a hand holding service. It's not a Discord. It's not a walk you through everything every single day. It's there to kind of give you guidance and encourage people to make decisions on their own, because that's how you're going to build your own confidence. And then I run regular screening webinars. And again, the promo code through the end of the weekend is take 100 off, and you'll get an additional month after you sign up. So you'll have access till the end of the first quarter of 2026, March 31st of 2026. So let's go back to market surge. Let me just share that. There we go. Are you using a checklist, and what is it? How to use it and when? Yeah, after I screen, I have real-time charting package where I will have the stocks that I own and maybe some that I'm looking at. I will say this other concept is it's a word acceptance that I use all the time. I accept I can't own everything. There's sometimes I'll see a beautiful setup and I'm fully invested. I'll pass it along to members. I won't buy it. Why? Because number one, I don't have room to buy it. Or number two is I just accept I can't own everything. But if the members make money off it and they're looking to buy it, that's great too. I also use the word acceptance for you're never going to get the highs or the lows. So sometimes I'll take profits into strength. Something might go higher afterwards. It's okay. It's just part of being calm and confident in what you're doing. Stop trying to be perfect in your trading. We're never going to be perfect. I make mistakes all the time. I just try to minimize those mistakes, and I'm honest with myself to constantly improve. So I don't claim to be a guru. I don't claim to be an expert. I just claim to be real, where I'm going to be confident in what I'm doing and try to keep people on the right side and present strong stocks for people who like to trade strong stocks. But when I'm wrong, I have no problem saying I'm wrong. And that's why I have a risk management policy and I have a stop in place. When I'm right and things are going well, I might say, okay, something's run a lot, nothing wrong with taking some profits depending on your time frame. So I don't claim to do anything. I say this all the time. I think what differentiates me from a lot of people is I make decisions and I'm okay with my decisions. I used to hem and haw and shoulda, coulda, woulda, and you end up shooting all over yourself when you're just always questioning yourself, until I finally just said, I'm going to accept. I'm not going to trade perfectly. I'm going to do the best I can and make decisions and what be okay with my decisions. Sometimes you stop yourself out, even though you love the name, and you say, I can always get back in if it sets up again. Sometimes you take profits and you're saying, wow, this is really strong, and then it ends up going higher. It's okay. I don't care because over time, you just want to be consistent and repeat a process that works for your style. So hopefully that helps. Uh, mm, mm. What's a good way to understand whether it's a natural normal pullback for the current market? You mentioned on X, the Nasdaq might find support at the 21 EMA. It looks like it's been working well so far. Is that your red line to get out? Yeah, on the weekly chart. So the 10-week moving average is an area of support. Even after COVID, it's an area of support. I've noticed when it breaks below that, the green line is the 21 weekly chart, and it found support a bunch of times there. So literally to the penny, that's why I tweeted it out I think it was a week ago, Friday. I said, we're approaching this level. It was like 21.9 on the NASDAQ. And what's the low there on Friday? 21,898. So sorry, I missed it by a point and a half, but I'm kidding. But that was around that level, and I just pay attention to it. And it was nice that we recovered because I just think this is a bull market with a correction in a bull market. That's what I think it was. And I don't want to say the 21 EMA was my line in the sand, but it was definitely an area I was watching because if we did break below that, I would have had to have reduced some more exposure. But as far as a natural and normal pullback in both stocks and in the indices, I'm looking at volume. And some people don't use it. I don't care. It helps me. I saw only a few distribution days. I don't get concerned until I see a cluster like 6, 7 distribution days in a short period of time. Yes, there was normal selling. Yes, after a monster move, you're allowed to correct. It's not fun when it corrects because the S&P corrected about 5% from that recent high to that recent 2 Fridays ago low, 5.7 from peak to trough. And the NASDAQ was about 10, but growth stocks corrected like the average growth stock corrected 40%. You can see it with ARKK, which is a basket of growth stocks. This corrected 20 to 25%. FFTY is an ETF. That's a basket of growth stocks. This also corrected 20 to 25%. So, but you also got to remember a lot of growth stocks from the April, May, even as recently as breaking out in September, in August, September, breaking out of this range here. A lot of growth stocks went up 100 to 400%. So, yes, it's not fun when they pull back, but you got to take the good with the bad. You can't have a stock go up 300% and then when it pulls back 40, cry about it. I mean, if you get a 300% gainer in a short period of time, you got to take some profits. So, but directly answering your question is I'm looking at volume of some of these things on they pull back, and I'm looking at the volume of the markets to make sure it's not a lot of volume. So that's why I've been saying this is a correction within a bull market, not a new bear market, because one, a lot of leaders were holding up well, and two, I didn't see a lot of distribution. And then the other point with individual stocks, I'm looking at that as well. So the market gives us clues during these pullbacks as to which ones are holding up well, which ones are holding logical support. So those are the types of things that I'm looking at. Can you share your stocks on AI names such as Oracle and CoreWeave, which has come under pressure given their financials in the market, questioning their ability to take on the debt and service it? Great question. The way I look at this is I'm not a genius. I know that's not really a profound statement. I don't have the resources and the brains and the analysts and the teams to go through things. That's why I say the institutions control the markets. If the AI spend is going to be a problem for Oracle or CoreWeave, where they're financing it through debt and their debt spreads are getting wider and it might be a problem, even though these companies have, in Oracle's case, Meta, they have great cash flows. But if it's a problem, it'll show up in the tape. And if the institutions aren't supporting it, that would be my area to stop myself out. Same thing with Meta. Even before the earnings, I was in it and I got stopped out here and did not have to deal with the drop below the 200 day. So something like CoreWeave, which is a great company, and I remember, full disclosure, it was building a base here. I don't want to only talk about the winners. I mentioned it. Well, we mentioned it off the IPO base, but that's a different story. More recently, I mentioned it in here, and as it started to break down, I got stopped out. And I told my members, look, it looks like a cup with handle. They have a huge backlog, but the market doesn't care what I think. It doesn't care about my opinion. You form your opinion, and you form your opinion, if I can speak English, and you let the market prove you right or wrong. In this case, it proved me wrong. I got stopped out. I got stopped out. I don't know. I think I bought it around 140 and got stopped out right around there, 120, 130, and got stopped out 110, 115. My point is, sorry if I apologize if I forget the exact area. I want to say about 130 and got stopped out at 115, give or take a few dollars. Anyways, I set up. This is one I passed along. I told the members I was in it. When it broke down, I got stopped out when it started to break down and was not acting well around that 50 day. And that's why you have a loss cutting discipline in place to avoid further damage. So, again, I ramble a lot. To directly answer your question, if any of these companies are having a problem because of their financing, as you beautifully worded your question, or because the market questioning their ability to take on debt, if it's going to be a problem, it'll show up in the charts. So I don't care my opinion, because the Fidelities and Janices and T. Rowe Prices and Vanguards and all of these big hedge funds, they have a team of analysts and resources way bigger than me. So I trust if they've done their due diligence and they don't like it and they're not going to support it, then that's the answer for me. So that's how I determine which ones are going to survive and not, and or be affected by this or not. But one other point is, it doesn't mean it has to be permanent. They can also fix that, and they can reset up and come back around again. So that's the other thing. It doesn't mean survive like Oracle's going to go out of business. It means that they might just need some time to fix that potential problem of the debt situation. Opinion on gold and silver. I don't have a strong opinion. I'm not a gold bug. I know silver closed at a new high today. And SLV is the main one. I mean, they're doing well. I don't have a strong opinion. You can trade anything you want. Like I said, the mining stuff, I mainly trade growth stocks, and I know there's some miners doing well and there's some growth there, but trade whatever you want, just manage risk. I don't BS people. I'm not a gold bug. I'm not anti-gold or, psychotically pro-gold or anything like that. I just don't have a strong opinion one way or the other. So I just pass on answering it. But with any chart, with any ETF, get those strong entry points and manage your risk around those positions. I'd rather just tell you the truth than make up some, BS answer to try to sound smart. If I don't follow something, I don't follow something. What else we have here? I know you mentioned you trade depending on market conditions, but what's your main style? Swing trading with a 3-to-1 risk reward. Um, Longer term position, trying to catch and ride potential big winners based on the CoreWeave examples. Sounds more of a position trader. Yeah, it just depends. It depends. Sometimes it's a trade where I just will trade something as a trade. Sometimes, if I've done a little bit more due diligence, it might be a position trader as well. And it's a little bit of everything. That's why I say it's kind of nuanced in the sense of, I have a style that works for me, and it depends on market conditions. I've been more bullish than most people over the past couple of years with the AI boom and some other themes, with drones and space and some other stuff. So I've had different time frames depending on that. But I've also talked about maybe this bull market goes into 2027, and then my style might be different, where it's more cash, shorter term trading and stuff like that. So it really just depends. There's no like exact way where someone says, what's your average time frame? It could be 2 to 3 days, 2 to 3 weeks, 2 to 3 months, 2 to 3 quarters. It really just depends. And then also, as far as, swing trading or position trading, it actually depends. I know Scott O'Neill, William O'Neill's son, one time says you have your A stocks and your B stocks. Your A stocks are the quality institutional ones. Those could be some of the core holdings in a portfolio, more position holding. And then your B stocks are more your trading ideas and swing trading ideas. So hopefully that helps to answer that question. Let's see. Do you follow the VIX to make any buy sell decisions? The direct answer is no. I think I've looked at the VIX 5 times in 28 years of doing this, so I don't follow the VIX. If yes, do you have any rules like VIX, below 18, 19? I don't look at the VIX. I try to keep it simple. You know what's funny is some people get offended when I tell them I don't look at something they look at, and it goes back to what I said earlier. Who cares? Do what works for you. I don't look. I get so much noise. I don't look at the VIX. I don't. It's. I'm not saying it's useless. It's just not something I look at. I don't look at Fibonacci levels. I don't look at retracements and so like. I just try to keep it simple for my style. But you asked, so I told you. It doesn't mean you shouldn't. It means you should do what works for you. So, just a reminder. Um, and I appreciate everybody for hanging out and some awesome questions that came in. The discount codes take 100 off, good through the weekend. And my web team will also add an additional quarter if you're interested. I'm very grateful for still a lot of people hanging out. So hopefully I kept you engaged, or if you fell asleep, hopefully you got a good nap out of this. Um, I appreciate you guys hanging out. I appreciate all the awesome questions. Whether you sign up or not, it's not the concern. What you really need to work on is building your own confidence, building your own strength. As that member who said, not member, but attendee who said they're new to this, you got to learn to make decisions and be okay with your decisions and start small to help build that decision making muscle. This is not easy. Trading stocks is not easy. Actively managing a portfolio is not easy. There's a lot of nuances to all this, but you can find a stock that can help your month, help your year, maybe pay for some student loan debt, maybe pay for a kid's wedding, maybe help pay off whatever. The whole point is there's great opportunities in the markets, and I'm a big fan of trying to find them to help out your year because if you're consistent and consistently profitable, as some of the best have been over time, it can really, really change things in your life. And that's why I'm very passionate about trying to find some of these winners and pass along ideas. And it's not just about stock ideas, it's really about building your confidence and your calmness to help you throughout your career because hopefully we're going to be doing this for a long time. So thank you for attending. Thank you for all the awesome questions. I'm very grateful. Enjoy the rest of your weekend. You only have one assignment to get out of the house. That's it. Do something away from the markets. That's the only favor I ask for everybody. Do something to help your mental well-being and your physical well-being. Go for a walk. Get away from the screens. There's more to life than money. Call someone you haven't talked to in a while. Tell someone you love them. Read a book. Do something to help your mental and physical well-being. That's your only assignment. It's kind of a longish weekend where that's where I'm passionate about the markets, but work hard, play hard. Make sure to do something to help your physical and mental well-being over the weekends and get away from the screens. Thank you for all your awesome questions. Some people are saying thank you. And they appreciate me taking the time to do this. I appreciate you guys as well. And hopefully we'll do another one soon. So thank you so much, and we'll see you next time.